calculation, and then I will brief you on the practical assignment. Yeah, the assignment will be practical. That means we need to do it by online. Yeah, okay. And then I will brief you on what to do. Yeah, what to do, and then there will be template provided, yeah, for you to get the data and then just put it into the template that I will be given to you, for you to make an analysis. Yeah, it's not difficult because the materials is provided by mine. It's just that you need to find the annual report, and then you need to find the figures, in order for you to get. All right. So let's move on to chapter 4. Okay. Chapter 4 is about, can you see the screen? So I hope that you can see the screen. All right. Chapter 4 is about financial instrument and market. So therefore, this one is more on the theory part only. Yeah. All right. So why financial market is necessary by a company? A company must need financial market. Yeah, because without financial market, they cannot flow the money outside. Outwards and inwards. Yeah. So who is responsible in the company? Who are the responsible person associate with financial market? One of them is finance executive. Yeah, another one can be accountants also. Yeah, they are the ones who always go to financial market, look for the opportunity, and get the best financing package that they can have to. Yeah. All right. So one of their job is to raise money. You see, the keyword here is to raise money. So that means, in other words, raise money, which is add more money. Because you need to bear in mind that company usually does not have money. Yeah, does not have money their own. We're talking about their own money. Yeah. So most of their money came from investors. Most of their money came from loans. Yeah. Most of their money came from sponsors and so on. They don't have their own money. So therefore, their job is to raise money to finance current operation and future growth. They have to ensure that operation is running as usual, and the business will be growth. Yeah, from years to years. Yeah, that is one main job of finance executive. Okay. Not only they have to find customer, which is sales based. Yeah, because from sales, I know that most of the company, they are too dependent on sales, because from sales they will get an revenue. Okay, there is nothing wrong with that. Yeah, there is nothing wrong with that. But too dependent on sales and or revenue is not enough. Yeah, it's not enough for company. So they also need to find money from. There are two sources of money that they have to find. The first one is from creditors. Okay, creditors, that means in terms of not only suppliers but also from finance companies. Yeah. Okay, why? Okay, this is because they are more on debt-based activities or liabilities such as bank loan, mortgage, notes payable, and etc. Suppliers, they can delay payment. So that's why they can also make money from that. Yeah, delay payment, save money for a while. And then from finance companies such as banks, so they can apply for the bank loan, and then they can apply for long-term loan, which is mortgage, notes payables, and etc. So that means more on debt-based activity. Because since there is a debt-based activity, the problem is, no matter company is growth or decline, they need to pay the debt. Yeah, because that is the commitment, the agreement between company and financial institutions. Yeah. Okay, the second one is investors. Okay, we're talking about this one, creditors, liability, and investor is more on equity. All right. Equity-based activities such as common shares, paid-in capital, and etc. So we're talking about the money that injected to company, whereby the investor will buy shares from the particular company. So the money injected will raise the company's fund, and then the company will give shares to investor. Whoever investor give the highest proportion will become a major shareholder. Yeah, the highest capital, we have so many investors. Yeah, we have so many investors. So therefore, yeah, the highest proportion will declare as a major shareholders. Yeah. Okay. Financial executive, you have to analyze and decide which sources of fund can stabilize future cash flow and earn the best yield or return. Again, yeah, we're talking about two options, which is debt and also equity. So what they have to do, if they have to analyze, yeah, which one give the better return in terms of lower cost and better return. Okay, if those lower cost and better return can satisfy the company, yes, they can take that. Yeah, of course, company does not want to take financing or any kind of financing that give higher cost and lower return. So they don't want that. Yeah, so they can return back those money as a win-win situation. For example, dividends, yield, capital gains, etc., and so on. So once they got the money, once they got the money, and then the company is operating, and then they generate the revenue, and then the revenue that they get from company will distribute to the giver, which is dividends to investor, and then repay back loans and so on. Okay, so that one I will give an example, illustration later on. Okay, so let's go to, what is this? Okay. All right, let me illustrate to you the example, or not example, more on debt and equities, how that works. Okay, first thing first, let's have a look at a company. Okay, let's say ABC Sdn Bhd. All right, initially, ABC Sdn Bhd does not have any money. They don't have any money. No money. So what they have to do, okay, hold on a second. All right, so what they have to do is they need to get money. All right, so one of the sources of money will be the first one, which is through debt or loan, and then the second one will be equity, which is shares. All right, we're talking about equity. That means more investor will come. That means investor will invest. So that means it's all investors. Okay, investor will buy shares to from ABC's number hard, and then investor will hold as a proportion of share. They will get a free shares. And then we're talking about debt alone. So therefore, they will borrow money from, let's say, banks, and then financial institution, credit company, finance company, and so on. So therefore, there are two sources. It depends on the company how much they want to take. Sometimes they take more equity than debt. Sometimes they take debt more than equity. So once the money injected, to company, all right, so they will operate. Okay, they will operate, and then once they operate, they need to find revenue or sales. Okay, so that means customer will come. So this customer will come. There are so many customers. There are so many customers. Okay, customer will buy product from ABC's number hard, and then the revenues coming, and then the revenues will be injected to ABC's number hard. Okay, so let's say that ABC number hard have a profit or better cash flow. All right. So what they have to do with the profit or better cash flow is, the first one is they need to repay loan. Because they borrow money from banks or financial institution or credit company or finance companies. Remember, ABC Berhad need to repay loan back. All right, how about equity? So as far as equity is concerned, yeah, all right. So what they have to do is they need to return back the benefit, yeah, to investors in terms of giving dividends and then giving splits, and then sometimes they need to give cash, free stock, yeah, and so on. Okay, and then yeah, dividend means that sharing profit. So they need to share profit among investor. All right. Okay, so the process is going on. After that, the process is still continuing until going on until, yeah, the company become bankrupt. The bankruptcy happen if the debt is more than equity until they cannot, yeah, pay. All right. Okay, so we're talking about operate, yeah, which is ABC, Senyam Berhad, yeah, from the debt and equity, they will buy assets. Okay, buy assets such as machine, land, vehicle. Okay, this one is for operation. This one is for operation. So that is how company operates in terms of financial. Yeah. Okay. Not only they have to buy asset, but also they need to operate as usual. Okay. So that is a little bit on debt and equity. Okay. Let's have a look at financial instrument. Okay. Financial instrument is a claim to the company's cash flow and assets designed to meet the financing needs of the business and to appeal to investor. Okay, we're talking about products. Yeah. Okay, so that means, yeah, claim to a company's cash flow, it means that when a company apply loan, make sure that the loan borrow from financial institution will receive by the company. Okay, but let's say if company is more on equity, they need to ensure that investor will buying shares to the company. So that is we're talking about claim, yeah, claim to ensure that they will get the desired cash flow. Okay, it is not greatly constrained by law or regulation, but subject to full disclosure requirement. This is some kind like additional information only, yeah. Okay, so there are three types of financial instrument. Okay, bond, which is long-term loan. Okay, common stock is more on equity. Alright, for hybrid securities is more on the combination between long-term loan plus with equity. It's a hybrid. Hybrid, that means it's a joint, yeah, between those two products, yeah. Okay, so let's have a look at the differences between bonds, common stock, and preferred shares. Okay, bonds, yeah, is a debt instrument issued for a period more than 1 year. That means, in other words, yeah, we're talking about corporate borrowing and lending. Okay, corporate borrowings and lending. Okay, one company become lender, one company become borrower. Okay, usually borrowings ni we talking about the deficit. The company does not have money. But lending is more on surplus, which is company does not have money. So the surplus ones here will channel the money into the deficit. Okay, so we're talking about long-term loan. Yeah, the requirement, it must be more than one year. Yeah. So therefore, yeah, the purpose of bond is to finance long-term investment. Since it's a more than 1 year, that means it's a long-term investment, which is more on projects. Yeah, this one talking about projects. The second one, finance current expenditure. Okay, probably this is because they have a problem with cash flow. Okay, we're talking about deficit cash flow. And the last one, finance project development, because project development usually requires millions and millions and millions. Yeah. Okay, so these are the illustration there. Okay, I give you an example. Let's say MRT company. Okay, I am sure that you know about MRT. Okay, MRT transit. This is the new railway project. Yeah. Okay, MRT transit. They don't have money, so that's why they become borrower. In order for them to initiate a railway project, yeah, therefore they want to borrow money from the lender. Okay, this lender is usually banks or finance companies. Okay, so MRT Transit will apply loans from banks or financial companies. Let's say, okay, hello banks, we are from MRT Transit. We are interested to apply loan in order for us to initiate the railway project. So in this case, MRT Transit will become a borrower or bond issuer, okay, which is borrower. And then banks or finance companies will become lender. So that's why lender will lend the money. Okay, and then remember, once a bond issuer got the money, they need to initiate the project, and then they start operating and then get the revenue. So that's why from that they need to pay back payments. That means repay back loans and then return back the principal. This is what we call as principal and interest. This is the interest. Okay, so there are three main components in bond, which are coupon rate, which is more on interest. Face value is more on par value is more on face value, which is principal. Maturity date, that means it's a period. Some projects requires 5 years, some project requires 10 years, and so on. It depends. Different project have different maturity date. Okay, the next one is common stock. Common stock is an equity investment that represent ownership in a corporation. Once investor purchase the share, that means they become owners. Let me going back to this one. Okay, so as you can see here, this is equity or shares. Once an investor buying shares from ABC Sdn Bhd, they also will become owners. They will become owners. So that's why they will they invested. Okay, even though small business also, if your family is running business but the capital is from somewhere else, that somewhere else become an owner, not the family. So need to bear in mind on that matter. So we're talking about equity perspective. Investor will purchase shares or invested into that company, and then the company become owners, and then they have right to claim dividends, splits, and free stocks, and so on. Okay, so that is how it works. Okay, only corporation can issue common stock. That means only company become a seller. Seller of the stock. Okay, the return on common stock in terms of capital gain and dividend. I forget to put capital gain. Where is the capital gain? Okay, this one. Capital gain. Capital gain means that. Okay, let me illustrate to you what that capital gain means. Let's say you buy shares with 1 ringgit and then you sell with 1 ringgit 20 cents. So therefore, you sell higher than a buyer price. So the profit will be 20 cents. So this is what we call capital gain. Whereby you buy with the low price and sell with the high price. And then it is also subjected to company's net profit. Better net profit will lead to the better dividend. That is how it works. Okay, hybrid securities is a combination of bond and also stock. A combination of bond and also stock. Okay, so this one we call fixed income. This one they can got floating income. Okay, so they will enjoy both. 50-50. Okay, so it's a junior to bond but senior to common stock. Okay, financial market. We're talking about market. Market is a place that whereby they can buy or sell. So that's why it's a place that trade buying and selling this financial instrument, because financial instrument is referring to the financial. Okay, and then it's a channel through which investor provide money to companies. That one we talked earlier about this one. Channeling funds. The money goes in, goes in, goes out, goes in, goes out. So that means the money operates is a money in and money out. Okay, so there are 4 types of financial markets. The first one, private equity financing. Okay, what does private equity financing means? Whereby buyout and venture capital firms organized as limited partnership make often high risk intermediate term investment. Okay, we're talking about the word private. Okay, it's more on private companies. Okay. Okay, so that's why sometimes private companies be talking about quite blue chip, or we're talking about very high reputable companies. Yeah. Okay. The second one is initial public offering, where private companies with the help of investment bankers sell ownership interest to public investor. The keyword here is with the help of investment bankers. Let me illustrate to you the second one. Yeah. Okay. Okay. How initial public offering works, which is IPO. Okay, there are two parties here, which is investor and companies. Okay, usually investor will purchase shares directly from companies, but for initial public offering, they will help or assisted by we call it as a third party, or middleman, okay, which is investment bankers. So investment bankers are the middleman between investor and companies. So if investor want to buy shares from companies, they can go through investment bankers. This one buy. And then if companies want to sell shares to investor, they can also need assistance from investment banker as well. Sell and sell. Okay, so that is a initial public offering works. Okay, but let me go through the third one, private placement. Okay, private placement is a difference between initial public offering, whereby, okay, this one is private placement, investor, companies. Okay, for private placement, no investment banker. The investment banker is not there, so therefore, they can buy straight away shares from companies, and then the companies can sell directly shares to the investor. Okay, so the difference between IPO and private placement is this one, investment bankers. The mechanism is a same. The last one, cross-border financing. Cross-border financing is a similar, except that for IPO and private placement is more on local. This one also is more on local. But for cross-border financing is more on local company towards foreign companies, or local companies toward foreign investor. So that is a cross-border financing. Which is one party must be a foreigner, party must be a local. Regardless of investor or companies. Okay, I think this is the last part. Yes, efficient market. Okay, what is the efficient market says about? Is the market in which prices respond rapidly to the new information. Okay, price respond rapidly to the new information. Okay, let me tell you why. Usually, the price is going up, going down, going up, going down. One of the factors that leads towards going up and going down because of update information or news. Sometimes investors are quite sensitive with the news or updates, that or speculation, that the media made. So that's why, the media play an important role in investor decision whether they want to buy more shares or selling more shares. Okay, I repeat again. Okay, the market price fluctuates. That means it can be going up and it can be going down. One of the factors is that investors are quite sentiment with the news, or updates, by media. So that's why the media play an important role decision to influence investor behavior. So that's why sometimes investors are quite sensitive and then alert with the news. Okay, and then they found out that, okay, with that news they can buying more shares or selling more shares. So that's why the fluctuation is going up and going down. But it depends. The information depends. If we're talking about the alertness of investors again the update or information. Okay, they have, so that's why accurate information or accurate news does not necessary to influence investors buying and selling decision of their shares. So that's why we have a efficient market. Efficient market means that whether we want to see if investors are truly alert or about the information or update or news or not. Okay, so the first one is a weak version. Okay, weak version happens when the current prices fully reflect all information about past prices. Okay, fully reflect all information. Okay, we're talking about internal information only. And then semi-strong form efficient when current prices fully reflect all publicly available information. We're talking about public news. And the last one, strong form efficient when current prices fully reflect all information public or private. Okay, we're talking about this one is a current news. Current news. But this one more on past. History only. Because sometimes history cannot be reliable sometimes. Because remember that buying and selling shares is doing by life. So that's why sometimes they are not too much dependent on past prices. Okay, so they are more alert on the current news. Okay, this one is still current news, but more on public. But for strong efficient is more on public or private. Okay, we're talking about, let's say, current one is a COVID-19. Okay, current news about COVID-19, we're talking about strong form and semi-strong form. But we're talking about 1981 or 1990 information. So that's why the one is a weak form efficient, because there is no dependency anymore. Okay, all right, that's all for the chapter 4. Okay, open to questions. Any questions so